Is the stock market standing on the edge of a historic crash? Or are we trapped inside a giant fear bubble, louder in the headlines than in the data? Tonight, I want you to sit with one uncomfortable truth. Whichever answer you choose will shape your portfolio, your stress levels, and your decisions for years. Because markets don't just move on numbers, they move on belief. And belief, yours, mine, and the crowd's, can be the strongest bull or the cruelest bear. Read the signals, own the game. Let's strip the noise down to the engines that actually drive the U.S. market: growth, inflation, interest rates, and liquidity. If you understand those four, you'll stop reacting to every scary headline and start seeing the structure underneath the drama. Then we'll map how America's cycle spills across the Atlantic and the Pacific, through the dollar, through bonds, and through risk appetite, shifting the ground under Europe, Japan, China, and the emerging world. In the end, you'll have a playbook, 3 plausible scenarios, the signals to watch, and a mental model to act without panic. First, growth. What's actually powering the economy? Under the hood, the U.S. still has pockets of real momentum. Public investment is reviving hard infrastructure. Private investment is pouring into digital infrastructure, chips, data centers, power, and the plumbing of cloud and AI. Services are sturdier than goods, and mega-cap technology, love it or hate it, still prints cash. But this isn't a broad rising tide. It's a 2-speed market. Leaders sprint, laggards limp, breadth narrows. That narrowness is why sentiment feels fragile. When a handful of names drag an index uphill, every stumble looks like an avalanche waiting to happen. Second, inflation and the expectations that orbit it. Inflation has cooled from its highs, but expectations are sticky. Rents, wages in service sectors, and energy can reheat the story on a moment's notice. Markets don't just price the present, they price the next breath. If investors think inflation could re-accelerate, yields jump, valuations compress, and fear gets a new headline. If they think disinflation is safe, the multiple expands, narratives soften, and fear loses its microphone. Expectations, not just prints, set the emotional weather. Third, interest rates, the price of money, set at the front by the Fed and echoed across the curve. Keep policy too high for too long, and you grind the gears of credit-sensitive sectors. Small businesses that live off bank lines, real estate that needs refinancing, cyclical manufacturers that depend on cheap capital. Cut too early, and you risk rekindling inflation and losing credibility. That knife edge is why markets become hypersensitive to a single adjective in a press conference. Rates are the gravity of finance, invisible, unrelenting, and always pulling on valuations. Fourth, liquidity, the bloodstream of the system. It's more than cash balances. It's the willingness and capacity to warehouse risk. Treasury issuance, quantitative tightening or easing, reserves sloshing between money markets and bank balance sheets. All of it determines whether the ocean is calm or choppy when a wave hits. When liquidity tightens, small ripples turn into large drawdowns. When liquidity loosens, bad news is often absorbed without a regime change. Want to understand why some awful days barely dent the trend, while other May headlines trigger air pockets? Follow the water. Now, the bear case, the real crash. Story. Start with commercial real estate, especially office. Work patterns changed, vacancy stayed, loans roll over into a higher rate world. If appraisals lag reality and lenders face valuation holes, pressure moves from buildings to balance sheets. Regional banks, crucial lifelines for small businesses, tighten credit. Tight credit slows hiring, capex, and inventory cycles. That's how a market problem becomes a Main Street problem. Layer on thinner profit margins after years of cost pressure. Higher interest expense eats into earnings. If revenues decelerate at the same time, markets no longer forgive high multiples. They punish them. And once earnings expectations start revising down in aggregate, sector after sector, the tape trades heavy. The most dangerous ingredient of all is psychology. Crashes usually begin when confidence breaks, when investors collectively realize the emperor isn't wearing enough earnings to justify the cape. A single data point rarely does it. The shift happens when people stop buying dips and start selling rips because they no longer believe the next quarter will save them. Fear misleads, signals reveal. Now the bull rebuttal, the fear bubble story. Megacap technology remains a profit machine, and AI isn't just a buzzword. It's a capex cycle. Data centers, chips, grid upgrades, software, and services compose a multi-year investment arc. Cash flow funds buybacks support per-share earnings, and leadership attracts passive flows. If the cost of capital drifts lower over time and earnings power holds, each pullback becomes opportunity rather than omen. Liquidity need not be abundant everywhere to be sufficient somewhere. Even with balance sheet runoff in one corner, reduced issuance in another, or a pivot in expectations can grease the gears. Markets don't require perfect conditions, just conditions that are good enough to deny the bears a catalyst. And remember, valuation doesn't kill a market, triggers do. Without a trigger, fear is a bubble. Loud, exciting, and short-lived. So which is it, crash or fear bubble? The right answer may be, it depends on the dollar. The dollar and U.S. yields are the global transmission belt. When the dollar strengthens and long yields rise, global financial conditions tighten. Capital flows favor safety. Emerging markets feel pressure as dollar funding costs climb and local currencies wobble. Commodities priced in dollars can sag, and risk appetite shrinks. Flip the script. If the dollar softens and yields stabilize or drift lower, risk appetite broadens, carry trades revive, and capital creeps back into higher beta assets, from high yield to small caps to EM equities. The U.S. doesn't live alone. It resonates through the pipes of global pricing. Look at Europe and the UK. They remain sensitive to energy dynamics and external demand. If the U.S. slows modestly but avoids a cliff, Europe can muddle through, sluggish growth, but no deep freeze. However, any new energy shock or a marked slowdown in export orders can reignite pessimism quickly. Sentiment there tends to amplify cyclical whispers into full-throated choruses. When Wall Street sneezes, the city and the continent often reach for tissues first. Consider Japan and the yen. The gap between U.S. and Japanese rates has powered years of carry trades. If that gap narrows, carry unwinds, the yen strengthens, and Japanese equities can swing sharply as foreigners rebalance. A weaker dollar can be a tailwind for Asia broadly, but it also forces investors to reassess currency risk. Volatility in FX is not trivial background noise. It's a moving wall for anyone crossing borders with capital. Then China. Property weakness there acts as a governor on demand for industrial commodities. When construction cools, so do prices for steel inputs and other cyclicals. But policy nudges, even small ones, can reset expectations. For the rest of Asia, the key isn't just Chinese growth, it's policy credibility and export profitability. If the U.S. merely sniffles instead of catches pneumonia, supply chains concentrated in tech and manufacturing can still thrive, especially where foreign direct investment is diversifying footprints. Now step into the emerging world. EM cycles dance with the dollar, U.S. rates, and fund flows. A strong dollar often means currency pressure, higher imported inflation, and slower rate cuts. A softer dollar means breathing room. Equity inflows, easier external financing, and a bid for cyclicals. Countries linked into the technology supply chain, logistics corridors, or resilient consumer bases tend to outperform once global conditions ease. For markets like Vietnam and peers in the region, two channels matter most: sustained FDI into manufacturing and electronics, and domestic credit conditions that nurture real estate prudently rather than recklessly. When the global backdrop is risk-on, those flywheels spin faster. What about gold, silver, oil, and crypto, the emotional gauges? Precious metals tend to reflect fear of systemic stress and the path of real rates. Oil captures geopolitics and global demand. Crypto lives at the edge of risk appetite. A fear bubble can lift gold without breaking yields. A true credit scare is harsher, simultaneous outflows from risk assets, a dash into havens, and cross-asset volatility that doesn't fade after one headline. Watch not the first spike, but whether the spike becomes a regime. So how do we convert all of this into decisions? Think in scenarios, each with distinct tells. Scenario A, a genuine crash. Low probability on any given day, high severity if it lands. It shows up when three things align. Earnings roll over decisively, credit conditions tighten aggressively, and system liquidity shrinks at the same time. The tells: high-yield credit spreads widening fast and staying wide, default rates climbing beyond idiosyncratic stories, jobless claims trending higher for weeks, and volatility stepping up to a new persistent range. In that world, you emphasize cash, high-quality duration if inflation expectations stay contained, reduce leverage, and let markets come to you. Scenario B, a rolling correction, the most common reality. Leadership cools, laggards catch a bid, and indices chop while breadth quietly improves. Valuations compress where they ran hottest and reset without breaking. Earnings hold up on aggregate. Labor data stays good enough. The dollar avoids runaway strength, and liquidity doesn't deteriorate further. This is where buy when they're scared, trim when they're greedy works within sectors. It rewards patience, position sizing, and a willingness to rotate rather than predict grand finales. Scenario C, the fear bubble pops and morphs into a melt-up. Headlines scream, data demurs, skeptics short, and then buyers on the sidelines capitulate into strength. Earnings revisions tilt up, buybacks accelerate, yields settle, the dollar softens and volatility grinds down. Prices overshoot to the upside, not because every company is miraculous, but because risk appetite outruns fundamentals for a while. The risk is obvious. Once exuberance floats prices far above the last layer of support, any surprise can punch a hole in the air pocket. Respect trend, but don't confuse momentum with immunity. You want a checklist, 8 signals to keep you honest. First, earnings revisions. Are analysts nudging estimates up or down across sectors? Momentum in revisions often precedes the tape. Second, credit spreads. Compare high yield to treasuries. Rapid, persistent, widening signals rising stress. Third, jobless claims. 1 week is noise. Multi-week climbs are message. Fourth, new orders in manufacturing surveys. Below 50 for too long flags weak demand. Fifth, broad financial conditions indexes. Tightening is a headwind, easing is a tailwind. No need to complicate it. Sixth, market breadth. The percentage of stocks above key moving averages. Wide participation builds durable trends. Seventh, the dollar index. An overly strong USD tightens the screws on EM and commodities. A softer USD eases them. Eighth, volatility regimes. Is volatility spiking and staying elevated or mean reverting quickly? Regimes matter more than single prints. Now, the mindset. Sophisticated investors hold 2 ideas at once, defense and offense. You don't have to choose one forever. You can build protection against bad states of the world, more cash than usual, higher quality bonds if real yields behave, less leverage, while also lining up a list of assets you'll add on fear rather than on euphoria. Great outcomes rarely come from heroic predictions. They come from adaptive process, position sizing that lets you sleep, time horizons that fit your temperament, triggers that are written down before you need them. If you invest outside the U.S., your North Star isn't a guru's tweet. It's the triangle of U.S. yields, the dollar, and global liquidity. When those ease, expose yourself to beneficiaries of trade, technology supply chains, and improving domestic credit cycles. When those tighten, respect currency risk, avoid fragile balance sheets, and don't let FOMO bully your cash. Remember, the global cycle is not synchronized. You don't need everywhere to be good. You need the conditions facing your assets to be improving at the margin. So where are we? Really? At the lip of a canyon or inside a funhouse mirror that exaggerates fear? The truth is that markets will always alternate between greed and fear because humans do. What you need is not a perfect label for the moment, but a durable lens. Watch growth, inflation, rates, and liquidity. Track the dollar and credit. Separate signal from spectacle. If the crash checklist lights up, tighten the sails. If the fear bubble hisses without confirmation, buy into discomfort, not into headlines. The real danger is not the market, but ignoring its signals. Tell me what you see right now. Is this a crash in the making, or a fear bubble getting loud before it goes quiet? Your answer matters because it becomes your plan, and your plan matters because it becomes your results. This content is for education, not investment advice. Do your own research, define your risk, and make decisions that fit your goals and time horizon. If you found this useful, hit like, share it, and subscribe for more market insights. Don't just watch the headlines, watch the signals with us.